Okay, welcome back, everybody. This is Chapter 2, Analyzing Transactions. I want to apologize to everyone. I accidentally did not hit the record button in class today, so I have to go through and just touch on the slides that we covered today for the online class, and also so that people in class can have what we just went over in class. So I do apologize for that. If I ever forget to do it, I'll make up for it. So pretty much I just went over the beginning of class that. Let me just double check, make sure I'm recording now. Okay. So beginning of class, I pretty much just went over a little bit more on our Moodle shell here, just talking about homework. Someone had a question about homework. Pretty much these practice exercises, the exercises and problems are located at the end of each chapter. So you can see here, it's at the end of chapter 1. Same here on homework 2. Into chapter 2, this assignment I'm only doing the exercises 2:1, 2:7, 2:16. So once again, homework's only going to be 2 or 3 problems for each chapter. They'll be comprehensive in nature, so it'll cover most of the material covered throughout the chapter. So that's what I'm talking about here. If you look at the end of your book, or not the end of your book, end of each chapter, there's some practice exercises, then there's exercises, and then problems. So I'm just labeling which problems I want you to do. I'm going to have you all work through these and submit them. And my goal is after we work through and submit them, then we're going to work through them in class a little bit to make sure everyone's on the same page and everyone understands it. I will tell you all the same thing that I said to my in-class lecture. Homework is pretty much going to be done to where it's just all or nothing. If you do good quality work, then you're going to get your credit. If you don't, then you're not going to get your credit. If you turn in stuff that's just halfway work, you'll get half your credit. Just because it's all or nothing or just mid credit doesn't mean that you can just jot something down prior to just turning it in and just expect to get full credit, because it's not going to happen. So just keep that in mind. Do good quality work, and it won't be an issue. Turn it in, you'll get your credit, and also that's going to help you on exams. So that's that with homework. In regards to quizzes, they're all gonna be short quizzes, just like you saw from chapter 1. They're all gonna be like 10 multiple choice questions. So that's gonna be that on quizzes. So just short and quick on that. So that's pretty much homework and quizzes. Like I said, I will be going over the homeworks in class. Quizzes that'll give you a good idea of what to expect on the exams. Other than the exams, will have some short answers, but those will mimic a lot of what you see out of homework problems. So no curveballs on exams. So hopefully not, as long as you're doing your work. So that's that with homework and quizzes. If you have any questions or concerns, please let me know. So let's go ahead and just get into our chapter 2 PowerPoint. Get into the content. Okay, so chapter 2 is analyzing transactions. Let's go over our learning objectives. So the first objective is to describe the characteristics of an account and chart of accounts. Describe and illustrate journalizing transactions using the double entry accounting system. Describe and illustrate the journalizing and posting of transactions to accounts. Prepare an unadjusted trial balance and explain how it can be used to discover errors. And describe and illustrate the use of horizontal analysis in evaluating a company's performance and financial condition. So using accounts to record transactions. First, accounting systems are designed to show the increase and decrease in each accounting equation element as a separate record. So this is going to be called an account. Once again, this is the Net Solutions November transactions that we went over from chapter 1. If you recall, transaction A was where Chris Clark contributed $25,000 to his bank account at the inception of the business, meaning when the business began. Sorry about that. So cash increased by $25,000, equity increased by $25,000. Next, remember, he used $20,000 to purchase a tract of land. So we're going to use cash, $20,000. So cash will be reduced to $5,000. And then we're going to have an asset of land come into play here of $20,000. And notice on the right side of the equation, nothing has changed with the liabilities and equities. It's still only $25,000 of Chris Clark's capital. Last transaction we'll look at here, just as a little reminder of what we just had, or a little repeat. We purchased supplies on account for $1,350. Supplies is an asset, so it's increasing $1,350. And also we purchased it on an account, so therefore we have a liability of an account payable, so that's also going to increase $1,350. So that's a little example, just a little catch back up on a reminder on how elements remove and affect the basic accounting equation of assets equals liabilities plus owner's equity. Next, let's talk about the T account. This has a title, which you can see here at the top, and that's just going to be based upon whatever account we're analyzing, whether it be cash or inventories or prepaid insurances, whatever it might be. And then you have a left-hand side and a right-hand side, each column. The left-hand side is going to be a debit. The right-hand side is going to be a credit. So let's take an example here of looking at a T account, analyzing the account of cash. So once again, the top has your title of cash. And each of these little letters here and next to it, this is just examples of transactions from up here. So you can see here cash. Remember, Chris Clark contributed $25,000 cash into it. We're analyzing the cash account, so that's why we're not worried about the capital side here. So he contributed the cash of $25,000, cash increased. So let's go back to our T account here. We're going to debit cash. Remember the debit side of the account. This is increases in cash, that money going in, $25,000. So let's go back here to the other side, B. Remember, if you call here, we purchased land for $20,000. Well, remember, we're only concerned with the account of cash here that we're analyzing with our T account. So its cash is being reduced by $20,000. So we're going to credit it $20,000 on the credit side. So as of right here, just with transactions A and B, we have a net cash balance of $5,000. So on and so forth. These are just, once again, transaction D, that's $7,500. You can see here transaction D, $7,500. Cash increased as well as that was relative to fees earned, so the equity increased. But recall, we're only analyzing the account of cash and the T account, so it increased by $7,500. Let's go back to our T account. Here's the increase in cash, $7,500. In transaction E, we've made a payment of cash of $3,650, so we credit it. Same thing on F. It's money going out of $950 and cash being spent of $2,000 here. So debits increase, credits decrease when it's an asset account. So the overall balance of cash after all these transactions, remember, we're only concerned with cash right here. You can see $5,900. So pretty much it's the same breakdown as we're going through here of the adding and subtracting. We're just adding and subtracting just on the T account with debits and credits instead of just in a single column here as we're used to a basic addition and subtraction. So pretty simple, just a different format here. That's your T account. And remember, this can be used for any account that needs to be analyzed for activity throughout a period. Next, we have the chart of accounts. This is a group of accounts for a business entity called a ledger. So the ledger is going to have the listing of the different chart of accounts. And it's pretty much just going to be listed. For example, like you'll have assets maybe be group 100, and then inventories would be like 101, 102, 103, 104, and so on and so forth. So pretty much chart of accounts, you just have a listing of all your elements, meaning assets, liabilities, equities, revenues, expenses, gains, losses. And they're going to be labeled with the numbers so you can identify the number of the actual account. You'll punch that number in and then make the journal entry, and then it'll be reflected in the accounts within the financial statements. So that's what the chart of accounts, that's what we're talking about here. And they're all grouped together in a ledger. So let's start with the element of a business called an asset. So remember, assets are resources that are owned by the business. Some examples of assets are cash, supplies, accounts receivable, and buildings. Let's talk about supplies. What we mean by supplies, these are inventories, right? So like goods on hand. So like say if we're a shoe manufacturing company, that would be like our inventory of shoes, right? Say if we build, if we're a manufacturer and we're manufacturing furniture, then lumber and screws and stuff of that sort is going to be our supplies. Those are assets. Accounts receivable. These come into recognition are recognized in terms of like trading with partners and stuff, and with customers. So if we extend a good or service on a line of credit to someone, meaning that we give that good or service to someone without them actually paying us up front, we're going to have an account receivable. That's what we're talking about with account receivable. Buildings, that's going to be a physical building, like where maybe machinery's housed, or vehicles like a garage, or even this building where classes are housed. So this building is an asset to Bluefield State College. Revenues are going to increases in assets and owners' equity as a result of selling services or products to customers, right? So some examples of revenues are going to be fees earned, commission revenue, and rent revenue. So fees earned, for example, say that we have provided a service for somebody and they haven't paid us yet. Whether they pay us or don't pay us, it's still going to be fees earned, right? So that's going to be our revenue. So pretty much our revenue is going to be the main purpose of a business being of how they actually produce money. What is their main means of being a business, of making money? So do they sell furniture? That's their revenue producing activity. So obviously you have to incur expenses to be able to incur revenues. So let's talk about expenses. Obviously, expenses is the using up of assets or consuming services in the process of generating revenues, which results in an expense. So an expense is something necessary in order to be able to turn a revenue, or to be able to produce a profit or a revenue. Some examples of expenses are wages expense. So businesses usually have a workforce that go about being able to produce whatever the goods or services are that the company is providing to the consumer. So obviously we have to pay those employees for their job performed. So wages expense is going to be as an example of an expense. Rent expense, that's another one. Maybe we rent a building that we operate out of and we owe rent at the end of every month or the beginning of every month. So that's going to be a good example of our rent expense. And then we have miscellaneous expense, which could be anything from like like utilities like gas or sewer or water, electric, stuff of that sort. So other miscellaneous expenses. Next, we have a little look at a chart of accounts here. So this is just an example here. Going back to the chart of accounts that we talked about here, just a group of accounts for a business entity and a ledger. A list of the accounts in the ledger is called a chart of accounts. So once again, this is the listing of the chart of accounts. So their asset accounts are the relevant assets here, but they're the chart. So if you want to make an entry for an asset, that's going to be in that chart labeled as the number 11. Accounts receivable 12, supplies 14, so on and so forth. Liabilities, accounts payable will be 21, unearned rent. Let's talk a little bit about accounts receivable on assets. Remember, accounts receivable is going to be something that either a customer or a trade partner, someone owes us, right? So it's something that we've extended that good or service, they owe us. So it's an account receivable, it's an asset, something that we have a value of, right? Let's talk about prepaid insurance a little bit. Prepaid insurance, this is like prepaying an insurance policy that would cover the year of 2003, and we paid at the end of 2002 in December. So in order to hold that, because we don't incur the expense until the following year, we hold it as an asset, as a prepaid insurance. The best way to think about this is think about paying for a ticket for a sporting event or a show or a play or some sort, and you've paid the money and you're holding the ticket, but you haven't went to it yet. So whoever you bought that ticket through, Ticket Hub, Ticketmaster, or directly from the company, they owe you that performance or that show, right? Because you've paid for the right to attend it. So until that you actually go and see that show, you've paid for the right in advance. So that's a prepaid expense. So prepaid insurance is like a prepaid expense. Until you actually consume that insurance or consume that ticket or go and watch that show, then that's an asset because you've spent cash for it. Accounts payable, once again, that's the opposite of accounts receivable. So if someone like a supplier or a customer or someone has given us something of value and we didn't pay up front, they gave it to us on credit, then we pay them. That's a liability. Unearned rent, that's the flip side of the coin of a prepaid. An unearned is where someone's actually, they say they've paid us rent for the month of January in advance. They paid it at the end of December. So until they actually utilize that apartment complex or that unit for the month of January, that rent is unearned. But we still receive the money up front, but it's a liability because we haven't provided the service that they paid us for. So that's the opposite of the prepaid. So those are liabilities. Owner's equity, once again, this is the money being put in from Chris Clark that he put in that $25,000, and the drawing is the $2,000 that he pulled out. So that's what plays into effect with these right here. We stopped here in class, so we'll go over the income statement accounts starting on Wednesday. So pretty much the long and short of the chart of accounts, this is just showing an example here. We have the different accounts here. It's the chart of them, and this just labeled by number here. So you know how to identify each account here. So that's it for today. Continue to work on Chapter 1 and 2 homework, Chapter 1 and 2 quiz. We'll pick back up with the income statement accounts on the chart of accounts here on Wednesday. So I hope everyone has a good day. Once again, I'm sorry that I forgot to hit record on this lecture earlier. I'll try to do better about that in the future. So everyone have a good day. If you have any questions or concerns with any of the content that's been covered, just give me a shout. I'll be more than happy to help you. So I hope everyone has a good day, and thanks again for your time, and I'll see everyone on Wednesday. Thank you.